Hi, folks. Tom Smith here. Why don't we go ahead and get started? We are doing another series of educational webinars this year focusing on certain financial authors that can actually develop strategies, proprietary ideas, ones that actually had trades in their portfolios that they can share with us. Chuck is one of those rare financial authors. We feel pretty comfortable with him coming out and sharing ideas with us. And for an educational purpose, he's really good at explaining things, and he has a great support group. For those of you that haven't been here before, I'm going to post our website up here. It's mytrademonster.com. If today's webinar, we're going to go pretty fast and furious. We don't have a lot of time. There's a lot of ground to cover. But if you miss something, want to cover something, please feel free to come back here. On the right-hand side of the page, you'll see where it says Web Archives. We will have Chuck's archives here tomorrow afternoon, probably afternoon Central Time. So feel free to come back, click on it, download it, play it back, whatever you'd like. At the end of the presentation, Chuck will be probably giving out a number or something for a support group that you can actually contact. If not, we'll have that posted tomorrow sometime. Otherwise, Chuck, are you with us?
Yes. Can you hear me, Tom?
I can. You sound well. Let me go ahead and pass the privileges over to you, and let's get this thing started.
Okay, great.
Okay, we can see the screen, Chuck.
Okay, great. Let me switch to slideshow presentation here. Okay, good afternoon, everybody. This is Chuck Hughes. I want to first thank Tom for taking the time to set up these educational webinars, and we appreciate his efforts in setting this all up. And today, I wanted to introduce a new program. I've been using this program for many years in real time, but I want to present the strategies for the first time, and it's called the Lifetime Income System. And the overall goals of the Lifetime Income System are, number one, to develop lifetime weekly, monthly, and quarterly income streams. And I'll show you the strategies I've been using for many years to develop these income streams. And the second goal is to present low-risk investment strategies to help you achieve your retirement goals. Or if you're in retirement, you could use these goals to help sustain your retirement. So all the strategies that I have in the Lifetime Income System are fairly low risk, and I would feel comfortable presenting these strategies to my mother or my family members because I know that they're low risk and yet they still provide a good return. So I would feel comfortable giving these strategies to my family members and friends and feel comfortable that these would be right for them for developing income streams and to help them in their retirement. So let's take a look at the various lifetime income strategies. We have the Paratrend Asset Allocation System, which we'll look at next, the Relative Strength System. We also have a stock strategy associated with the Paratrend system. We also have a strategy for selling option premium that allows you to become your own bank. And instead of trading options in a speculative manner, when you buy an option, the cost of the option or the premium is deducted from your brokerage account. Well, we have a strategy that does just the opposite. We have a strategy that allows you to sell option premium and collect cash into your brokerage account, and you can become your own bank. We also have a strategy, and I've covered this in previous webinars, where we use weekly options to collect option premiums. So we sell option premiums every week. I sold some today, and these are short-term trades that last 1 week, but they allow you to collect cash every week in your brokerage account. We also have the MLP strategy and the REIT income strategy, and we also have a strategy for which is the lowest risk way to invest in stocks, and that's to use put options to protect your option position. So this series of strategies were developed to allow you to develop income streams and to also help you achieve your retirement goals, and if you're in retirement, to maintain your retirement. So these are all fairly low risk, and yet they provide very good returns, which you'll learn about today. And in upcoming webinars, we won't be able to cover all these strategies today, but I will be covering these in upcoming webinars, just so we can go into depth on each of these strategies, because I really feel that these are a good way for you to take that portion of your trading assets or your trading funds and put them into strategies that will develop income for you, and also provide low-risk returns for that portion of your portfolio that you want to have your so-called safe money, and you want to have a lower risk strategy. So these are perfect strategies for that portion of your portfolio. So the strategies, the lifetime income strategies, have produced over $2.6 million in actual profits the last 4 years, and I currently have over $402,000 in open trade profits for these strategies, and I currently have an average return of 56.2%. And what I'll show you here real quickly is I have 2 retirement accounts that I trade these lifetime income strategies, and I'm just going to show you current snapshots of my open trade profits in these 2 retirement accounts, just so you can get an idea that yeah, these things really are working, these strategies really are working in the current market environment. So again, these 2 retirement account snapshots will show over $400,000 in current profits, average return of 56%. So in my first retirement account here, I have an open trade profit of $303,000, and this is the stock and ETF portion of that retirement account, and here's the option portion of that retirement account. Again, this account has $303,000 in open trade profits. Here's a snapshot of my second retirement account. This is a profit sharing plan, and I currently have $98,000 in open trade profits. So these, as I mentioned before, the lifetime income strategies, I've been using these for many years. Actually use them in my retirement plans, and you can see the current results here. So the strategies produced over $2.6 million in real-time profits over the last 4 years, and this was during a very volatile period in the markets where we had these non-trending type markets with a lot of price volatility, a lot of price swings, but very little trend. So if you can make $2.6 million over the last 4 years, that really demonstrates the ability of these strategies to deliver excellent returns during very difficult market conditions. And a couple of the strategies we focus on selling option premiums. So in my lifetime income system book, I list the cash that I received in my brokerage account from selling option premiums. So I have over $7.4 million in cash going into my retirement accounts over the last 5 years from selling option premiums. So I list all those trades in the Lifetime Income System book. So if you average that out, that's about $124,000 in cash income per month going into my brokerage account. So selling option premium is a big part of the Lifetime Income System. And the new market reality is we have slower economic growth than we've had in past recoveries. We have lower corporate earnings, lower stock returns. We still have high unemployment and lack of high-paying jobs. And over the last 4 years, we've had a lot of market volatility without much trend. And overall, just a lower standard of living in this slow growth environment. So that's the economic backdrop that we're facing, trying to get good returns as stock and option investors. So let's look at the first of the Lifetime Income Systems. This is an asset allocation system, and we use a simple trend following system in combination with asset allocations to implement this low risk strategy. And the nice thing about this strategy, about Power Trend, is it only takes about 10 minutes a month to implement this system. And you're only looking at a stock or an ETF on the last trading day of the month. And you ignore all the other trading days. So you can literally trade this system in 10 minutes a month. So let's first take a look at some recent price activity for the S&P 500. And I just picked out different time frames over the last several years. And all these, what these have in common, these price graphs of the S&P, is you can see a lot of volatile price moves here, but at the end of the time frame, the S&P is virtually unchanged. So we've had a lot of this kind of activity. Here's 2011, 2010, and in 2011, the S&P was actually unchanged for the year. So this is the type of markets we've been faced with the last 4 years, and despite this type of market activity, I'm going to show you some great results for this Power Trend system, and it has the ability to profit regardless of these difficult market conditions. So the Power Trend asset allocation system, it's a combination of trend following and asset allocation. And despite the simplicity of this and the fact that it only takes 10 minutes a month to implement, this asset allocation system has not had a losing year since I did the historical testing since 1973. And what I used were to test these various asset classes. I used indexes that became available in 1973. In other words, I couldn't go back any further than that because some of the indexes for the various asset classes weren't available before 1973. But from 73 forward, there were indexes that enabled you to track these different asset classes. Of course, the U.S. stock asset class, that could be tracked down a lot earlier than 1973, but the 5 asset classes that we're going to look at, we didn't have indexes to track all 5 of those asset classes until 1973. So the testing goes forward from 1973. And on the trend following portion of the system, I've been using trend following successfully for more than 28 years. And the trend following, if you're following a system, it eliminates emotional decision making and subjectivity, and it allows you to follow the trend instead of trying to predict the trend. So this, for the average investor or trader, this is a much better approach than trying to predict where a market's going to go. So we simply follow the trend and we follow a system, and this enables us to have the discipline to follow a system even when we have difficult market conditions. So we use moving averages to quantitatively measure price movement. And the paratrend system, it's simple to implement, and it's totally mechanical. And the paratrend system is not optimized, and it works across a wide variety of markets: stocks, bonds, currencies, metals. And the nice thing about this, the paratrend system, is you can change the parameter and it still works in all of these markets. So it's not optimized, and it works in virtually any market, and you can just change the parameters around and get similar results. So that's a sign that going forward, that type of system tends to work rather than one that was optimized for a certain period of data or a certain market. So I've been using this trend following type system for many years, and I know that the best way to approach this is to get a system that's not optimized, works in all markets, and you can change the parameters and it still has similar results. So I found through all these years of experience trading these trend following systems that's the best approach to take. And with the paratrend system, the buy rule is if the monthly price of a stock or ETF is above the 10-month simple moving average, then that stock or ETF is on a buy. And if the monthly price of a stock or ETF is below its 10-month simple moving average, then that stock or ETF is on a sell. And we only check the stock or the ETF on the last trading day of the month, and then we ignore all other days. So on the last trading day of the month, we look at the price of the stock, and if it's above the 10-month simple moving average, then we buy the stock. If the price of the stock on the last trading day is below the 10-month simple average, then we sell the stock. So it's a very simple system. Literally only takes minutes a month to implement, and we just simply ignore all the other trading days, and we just focus. We only have to check the markets that last trading day of the month. So pretty simple system to implement. And the 10-month simple moving average can be downloaded from stockcharts.com, and you would select monthly price data, and then under moving average, you would select 10. So what this gives us is the monthly price of the S&P, which is this line, and it also gives us the 10-month simple moving average, which is this blue line. So it's a very simple system to implement. On the last trading day of the month, we look to see if the stock or ETF is above that 10-month simple moving average or below it. And we can see right here the S&P 500 index crossed above the 10-month simple moving average, so the index became a buy here. And here's a more detailed look at this. We can see the S&P 1-month price on this line, and we can see it crossed above right here. So once it crosses above that 10-month simple moving average, then it becomes a buy. So if you would have checked the S&P price and you see it's above that 10-month simple average, then at that point it becomes a buy. So here's an example of the buy signal, and this was January of 2012. So if you looked at the S&P on the last trading day in December of 2011, you would see that it's below that 10-month simple average. So we wait a month, and then the last trading day of January, we take a look at it, and we can see it was above the 10-month simple average, so it becomes a buy on that last trading day in January. So that's how the system works. Pretty simple, and you only check the markets that last trading day of the month. And these long-term moving average systems have been around for a while, and Jeremy Siegel, in his book Stocks for the Long Run, he tested the Dow Jones Industrial Average from 1886 to 2006, and he used a 200-day simple moving average, which is pretty similar to the 10-month simple moving average. And he also tested the NASDAQ from 1972 through 2006. And what he found with these long-term moving averages is that it not only increased your returns compared to a buy and hold approach, but it also greatly decreases the risk by avoiding big down moves. So the whole idea behind these systems is you simply exit a market once it goes into a bear market. And going back to 1886, these long-term simple moving average systems have worked pretty well. And the big plus with these is it gets you out of the market when it starts to go into a bear market, and you avoid those big losses that can really decimate your portfolio. So it's a timing system that's been around for a long time, and again, the real value in these simple moving average systems is they get you out before big downturns, and they allow you to preserve your capital, just stay flat until the market turns bullish again. Here's an example. This was during the recent bear market, and you can see here's the price of the S&P 500, and it crossed below the 10-month simple moving average. It looks like November or December of 2007. So back when the S&P was trading around 1310, the Paratrend system issued a sell signal for the S&P, and you can see if you got out around 1310, you saved yourself a lot of pain and grief, because the S&P went down below 700 all the way from 1310. So the idea is you would exit here and just stay flat and wait till the S&P rebounds and is back on a price uptrend. So we can see that it bought back in around the 850 level on the S&P. So this saved you a lot of pain right here and preserved your capital. You still took the majority of the profits out of the bull market run here, took your profits and just waited until the market turned bullish again and got back in at a very good entry level. So that's the thought process behind these simple moving average systems. You don't capture all the profit, but you can see you're pretty close to capturing all the profit during this bull run here. Simply exit, stay in cash, and then enter the markets when they're back on a bull market uptrend. here's another example. This was during the bear market in 2000 through 2003, and again, you can see the price of the S&P dropped below this 10-month simple moving average around the 1150 average, 1150 area right here, and then of course the S&P went on to decline all the way below 700 again, and then it jumped back in around the 720 level. So again, it saved you a lot of pain, and you captured most of the profit during those late 1990s bull run. Captured most of the profit, got out, stayed flat. There was one. It looks like there was one signal right here where you would have gone long, and then probably the next month got out right here. So that probably would have resulted in a small loss. But you can see that despite this small whipsaw trade right here, it saved a lot of pain, got back in around the 720 level. Now, all of the G7 countries' stock markets have experienced declines of 75% or more. So if you have a 75% decline in a market, or if you own a stock or an ETF, if you have a 75% decline, it would require a 300% return to get back to even from a 75% decline. So if you're in that situation, it would take 15 years if you were able to compound your returns at 10% a year to get back to even. So the idea is you want to avoid these big types of declines, and of course a simple moving average system will allow you to avoid those big types of declines, and it can prevent big losses, such as the emerging markets in the late 1990s, Japanese stocks in the 1980s, U.S. stocks in the 1920s and 30s, and all the German asset classes in the 1910s and 1940s. So the idea here is, with these long-term simple moving average systems, you avoid these big losses that take many years to recover from. And I got the idea of the asset allocation from a book called the Ivy Portfolio, which was written by Mebane Faber. And what he did was he introduced the concept of using different asset classes along with the 10-month simple moving average to come up with a simple asset allocation system that's done very well, very low risk over the years. And he divided his funds into 5 asset classes: U.S. stocks, foreign stocks, real estate, commodities, and 10-year treasury bonds. So the idea here is, if U.S. stocks aren't performing well, then hopefully one of the other asset classes, such as commodities or the 10-year bonds, are performing well. So you rotate in and out of these asset classes, and the idea is you diversify your portfolio and you take advantage of markets that are in a strong bull market, and you simply stay out of the markets that are not in a bull market. So this has worked out very well by diversifying your portfolio in these 5 asset classes. And it uses the 10-month simple moving average to time these buy and sell signals. Now, over the long term, stocks have always provided the best returns, and this was some research I did. And what I did is I compared these different asset classes over the last 70 years. And inflation was about 4% a year. So the treasury bills, the average return was 4.1%, which was just above inflation. So the real return for Treasury bills is 0.1%. Gold returned about 5% a year. Treasury notes 5.5% a year. Corporate bonds 5.7. Home prices 6.1, and common stocks, as measured by the S&P index, 10.8%. So the stocks have always provided a much higher return than these other asset classes. But there are periods of time when these other asset classes will outperform stocks. So you want to be in some of these asset classes if they're in a bull market. And what I did is I took a couple snapshots just to demonstrate this concept. And this is a price chart of the S&P 500 index. And over the same time period, we have a snapshot here of the ETF that tracks the 7 to 10 year Treasury bonds. So you can see, even though over the long term stocks outperform all other asset classes, you can see during this time period that the S&P was in a downtrend and bonds were in an uptrend. So you'd want to be in bonds and out of the S&P. So the system would allow you to do this. In other words, we'd be flat the S&P during this period, and we'd be long bonds, and we'd be profiting even though the S&P is in a price downtrend. So by diversifying in these different asset classes, it allows us to make profits in any type of market. Here's another time frame. This was during the 2000 through 2003 bear market, and again we can see the S&P suffered about a 50% decline during this bear market, but we can see real estate was in a price uptrend. So you'd want to be out of the S&P and in real estate during this time frame, and that's in the Paratrend 10-month simple moving average system allowed us to do that. Here's one more comparison. This is the S&P and the Dow Jones Corporate Bond Index. Again, we can see in this period, 2000 through 2002, strong returns for bonds, strong bear market in U.S. stocks. So we want to rotate in and out of these asset classes depending on their price movement and whether they're in a price uptrend or downtrend according to our system. Here's another example. This is the S&P versus, again, the Barclays 7 to 10 year Treasury bonds. Again, we can see the S&P in a bear market and bonds in a bull market. So what I did was I did some historical testing with these 5 asset classes and divided up $10,000 evenly between these 5 asset classes, and then use the 10-month simple moving average to time your buys and sells. And again, you only look at these markets on the last trading day of the month, and you ignore the markets the other days of the month. So if you invest $10,000 in these 5 asset classes using the 10-month simple moving average, I have the historical results here, and a $10,000 investment in 1973 grew to over $618,000. That's about a 6,087% return before commissions, and that averages out to about 152% average annual return. And the big thing to keep in mind with this profit graph here is we had 3 severe bear markets during this period, and yet the system was profitable every year since 1973, which is about a 41-year period. So In 73 and 74, we had a severe bear market, 2000 through 2002, and then, of course, 2007 through 2009. So in each of those severe bear markets, the S&P lost more than half of its value, but the asset allocation system was profitable every year since 1973. And I'm just showing some examples here of the current markets. This is the ETF for the U.S. stock market, and you can see back in January of 2012, the system went long U.S. stocks right here, and this is the price movement of ETF right here, and the blue line is the 10-month simple moving average. So U.S. stock asset class is on a buy since January of 2012. Here's real estate ETF, and the real estate ETF also went long in January 2012. And here's a snapshot of the foreign stock markets as represented by the Europe, Far East, and Australia index. And we can see that in August of 2012, foreign stocks went on a buy signal right here. So those are just examples of current asset classes and that are on a current buy signal according to the paratrend system. So in looking back over that 41-year period, the system was invested about 70% of the time on average. So 70% of the time you were in a market, 30% of the time you were flat. 50% of the trades were winning trades, but the winning trades were 9 times larger than the losing trades. So that's a real key statistic right there. When your winning trades are 9 times larger than your losing trades, then that's an indication that the system gets you out before a big loss. And of course, the whole secret to investing over time is to avoid these big losing trades during down markets and to let your winning trades run. So that's the whole secret to portfolio management, and the system allows you to do that. So it's the holy grail of providing higher investment returns with lower volatility. And I find myself personally following a system gives me the discipline to stick with the system during difficult markets. And we saw the historical results, and again, since 1973, we had those 3 severe bear markets, but the system was profitable during those bear markets. So that gives you the discipline to stick with the system when you have these types of markets. Here's 2012. When you have these difficult type markets, if you're following a system, it can give you the discipline, to stick with the system during difficult markets. And there's one other thing I want to mention with the asset allocation system is there's leveraged funds available for the 5 different asset classes. So I did some historical testing using leveraged funds, 2 times 2 beta funds, or 2 times the fund, leveraged fund. And of course, when you use leveraged fund in historical testing, then the numbers get really big. So $10,000 grew to over $23 million over the same time period, and that resulted in over a 235% return before commissions. Now, of course, these leveraged funds, they weren't available during this test period, so this is just hypothetical, but still it gives you an idea of the profit potential of the system if you used leveraged funds. And I do use leveraged funds when I'm trading the system. And there's one thing I wanted to mention about these leveraged funds is there's a lot of misconceptions, I think, about these leveraged funds, but the objective of the leveraged fund is 200% performance on a daily basis. In other words, if you're in a leveraged S&P fund and the S&P closes up 1% for the day, then the leveraged fund, the objective is to produce a 2% return, or twice the daily performance. And if the S&P is down 1%, then the leveraged fund would be down 2%. But it's only calculated on a daily performance basis. And now over time, compounding comes into effect with these leveraged funds. And I've seen cases where the compounding allows the leveraged fund to outperform by more than 200%. And also I've seen cases where the compounding would result in the leveraged fund underperforming the benchmark. So the leveraged funds are only, their goal is only for that particular day in the performance of the S&P or whatever index you're looking at. So it's only the performance on a daily basis. And if you look at a time frame longer than one day, then compounding comes into effect, and you can have more than 200% performance or less than 200% performance, depending on the trend of the market. So the compounding comes into effect if you're looking at a time frame more than one day. So let's just look quickly now at the power trend stock strategies. And we use the same trend following system to buy and sell stocks. And again, it's we only look at the stock or the ETF on the last trading day of the month, so it doesn't take much time to implement the stock strategy. And again, we use the 10-month simple moving average to time the buys and sells. And again, it's we use a trend following system, and that eliminates the emotional decision making and subjectivity of our trading, and it allows us to just simply follow the trend instead of trying to predict it. And the stock strategy is similar to the asset allocation in that it's not optimized, and it works across a wide variety of markets, and you can change these parameters from the 10-month to the 6-month or the 8-month or the 12-month, and it's really not going to make much difference. So that's to me is an indication that the system is robust and it has a good chance of working going forward, as opposed to an optimized system that's optimized over just a certain period of time or a certain market. So with the buy rule, we want to buy a stock or an ETF if the monthly price is above the 10-month simple moving average, and we want to sell a stock or an ETF if the monthly price is below the 10-month simple moving average. And again, we only check that stock or ETF on the last trading day of the month, and we ignore the other days. So let's look at an example. This is for Magellan Midstream Partners, and I created this chart from stockcharts.com, and again, it's the monthly price data and the MA10, and that will give us the monthly price of the stock, which is this line here, and it gives us the 10-month simple moving average, which is this blue line. So we can see that this stock was below the 10-month simple moving average, crossed above it in April, and that became a buy signal around the 1350 price level. So here's the buy signal right here, and the system went long on the last trading day of April as it was above the 10-month simple moving average. And here's a longer-term time frame, and again we can see the system went long here at around 1350, and the stock is trading around 45 now. So it's caught a nice up move, and as long as this that 1 month price of the stock is above the 10-month simple moving average, we want to stay long. So here's an example of the system going long here and stayed long as the price stayed above the 10-month simple moving average. So we're letting our profits run on this one, and we're not cutting our profits short as long as the stock is on a buy signal. Here's what I did was I did a historical testing for this stock, and we assumed that you invested $10,000 in the stock 10 years ago. So that $10,000 investment grew to $65,000 over the last 10 years, and that produced a $55,000 profit and a 550% return. So here's an example of just simply following the 10-month simple moving average and getting a really good return. And again, over this time period, we had, the severest bear market since the Great Depression right here. But the system allowed us to do well over this time period and produced a 550% return over that 10-year period. So what I did was I did some historical testing for a diversified portfolio of stocks in different industries, and the historical testing assumes that we took a $10,000 investment and invested in these stocks in different industries, and we used the 10-month simple moving average system to time our buys and sell signals. And you can also trade call options with these buy signals for these stocks, and I have done that in the past. If a stock or an ETF goes on a buy signal, you can either buy the stock or you can buy a call option. So you can trade call options with these signals. So what I did is I tested these stocks in different industries here: Monsanto, Union Pacific, Sherwin-Williams, Magellan Midstream Partners, Whole Foods, and MasterCard. So these stocks are all in different industries, just to give you an idea of how the system performed over the last 10 years. And a $10,000 investment divided up between these stocks evenly produced, the $10,000 investment grew to $82,785. So that's a 727% return. And again, we had the most severe bear market since the Great Depression during this period, and this portfolio was profitable every year over the past 10 years. So despite that severe bear market, the system got us out before any big losses occurred in those stocks. So even though we had the biggest bear market since the Great Depression, the system was still profitable every year with this portfolio. So the system's longer term, but it provides very good profits and keeps your risk to a minimum. So great system for the current market conditions that we're in. Here's the stock ETF current open trade portfolio results here, and we currently have a $72,000 open trade profit, average return of 89.6% for this diversified portfolio of stocks and ETFs using the Power Trend system. So that concludes my presentation for today, and we just looked at the first part of the lifetime income system, and in upcoming webinars we'll cover some more of the other strategies, and I'm hoping you learned a little bit about how to develop income streams and low-risk investment for your retirement funds, or if you're in retirement, to keep you in retirement. So that concludes my presentation. I'd be glad to take any questions.
Sure. Chuck, we have some questions already. People are asking, based on the premise of your Power Trend system, can this be used based on any product out there as long as it's an ETF?
Yes. Yeah. Well, ETF or stock. Yeah. As long as you can track the price of it, whether it's an ETF or a stock or a currency, as long as you can track the price of it, you can calculate the 10-month simple moving average. So this will work on any market that you can track the price.
In the future webinars, and for those of you that haven't been here and heard Chuck before, we do have other webinars, and I'll post up the website where he's got some of his stock selection process and other strategies he utilizes. It's a lot to cover in 40 minutes. But the instruments that you're using on a 10-month MA, should one ever go to cash, Chuck, or short a position, hedge a position? Just a real quick answer, because I know you'll cover that in the next webinar.
Yeah, well, when we're using the 10-month simple moving average, we're long when that 1-month price is above the 10-month simple moving average. And then if the 1-month price that we check on that last trading day of the month, if it's below that 10-month simple moving average, we simply move to cash. And that's the way the system is set up to be low risk.
Okay. Well, Chuck, hopefully we could do part 2 in several weeks, if that's okay by you.
Yes, I'd love to. I have a lot of great information I'd like to look in detail at. We've got some really great strategies with this program. So, and I really feel good about teaching people these strategies, because I'm very comfortable with the risk level of these strategies. And like I say, I would, and I have given these strategies to my mother and my and my family members to use, because I know that these strategies will keep them out of trouble and yet still provide a good return. So I'm very comfortable with these strategies, and I enjoy explaining them and helping other people to employ these strategies in their investing. So it's great for developing income, or if you're saving for retirement.
Well, one last question, Chuck. This is out there from Randy Rich. Have you ever used inverse ETFs in this Power Trends? And if so, is that something you would cover?
Yes, I have used inverse ETFs, and we did trade inverse ETFs during the last bear market. We had a lot of short positions, which consisted of put option spreads, and inverse ETFs. And I have a relative strength system where part of that relative strength system is inverse ETFs. So if the market turns bearish and these inverse ETFs start to increase in price, and they have better relative strength compared to the long ETFs, then the system will buy the inverse ETFs. So yes, we have used those in the past, in past bear markets, and I had my advisory service. It's been I've had it in operation since 1999. So we also went through that severe bear market in 2000 through 2002, and we did great with a combination of bullish and bearish positions. And so yeah, to answer the question, yes, we do use the inverse ETFs.
Right, folks, I know there's a lot of questions that want to be asked. Chuck has done numerous webinars with us. I'm going to pull up our website over here at My Trade Monster just to give you an indicator on actually how you can come in and take a look at some of these. Chuck has done over a dozen of them with us. This one I find to be really good, Chuck, the ones that you did, the two-part series back in September. This gives the foundation level for Chuck's stock selection process, and it talks a lot about his moving averages, etc. Chuck, would you think that's a good starting point for people moving forward?
Yes, yeah, I do. Yeah, I think looking at that, the trade selection webinar series is also a good background for trade selection for whether you're trading stocks or options.
Okay, for those of you that want to listen to the archive tomorrow, I'll have it here on mytrademonster.com. It will be listed right here, right under March. If you do have questions, you'll be able to contact Brad and Chuck's support system. If you have questions regarding the auto trade or something regarding options or IRAs or brokerage on the Chuck, so what we'll do is we'll expect you out next month to give a part 2 in our webinar.
Okay, that sounds good. I want to thank you, Tom, again for taking the time to organize this webinar, and it's much appreciated by everybody. And I'm looking forward to our next webinar, and I want everybody to have a good day. It's been great being here today, and looking forward to our next one.
Yeah, that sounds great, Chuck. Thanks again. And again, one last time, for those of you that do want to listen to this archive, I'll have it here tomorrow right around lunchtime under the month of March. If you do have questions, Brad and Chuck's support group, you can contact them for Chuck's any questions you may have regarding his strategies, his newsletter, subscriptions, etc. If you have questions for us, please check back here at My Trade Monster. Here's our information. We'd be happy to address any questions for you. Otherwise, Chuck, I look forward to next month's webinar, and I want to thank everyone one last time for coming out, and I do as well. Hope everyone has a nice weekend, and thanks for joining us. Have a good night, everybody. Thanks again, Chuck.
Okay, good night, Tom. Good night, everybody.